The movements of the stock market signal everything from investor confidence to the general health of the economy. So what is the stock market and how does it work? This is the stock market explained by The Simple Economy. The stock market refers to markets open to the public that exist for issuing, buying, and selling shares in businesses. In the UK, the main market is the London Stock Exchange, whilst in the US, it is the New York Stock Exchange. So the stock exchange is where we buy and sell our shares. But before we go into how it works, it's important to understand how and why businesses list their shares on the exchange in the first place, in the process known as an IPO. IPO stands for Initial Public Offering. An IPO is when a private business lists their shares on the public markets for the first time in order to raise money. The company must go to a stock market like the London Stock Exchange and apply to list their shares. If they comply with the strict rules and pass the necessary steps, they can go ahead and list their shares on the exchange. In an IPO, the company employs an investment bank to help them value and then sell their shares. Companies want to issue their shares at a fair price. They don't want to set the price too cheap that they will then regret not setting a higher price, and they don't want to set the price too high that no one wants to buy them because they're too expensive. Once a good price has been agreed, the investment bank helps sell the shares, usually to their best contacts, which will be other investment companies and their clients. Either way, those shares are now there to be freely traded in the stock market, and this is where you and I will usually buy and sell our shares. Once the shares are in the stock market, the price is no longer fixed. The price of a share is determined simply by what a buyer is willing to pay for it and what a seller is willing to sell it for. If a broker can match the prices, then the transaction can take place. So we can actually think of it like buying a house. A share IPO is like buying the house brand new directly from the building company for a fixed price. And buying shares in the stock market is just like buying a house in the market. You're buying it second-hand and negotiating a price with the seller that suits the both of you. The housing market, just like the stock market, is driven by supply and demand. If the number of people suddenly wanting to sell their house increases, supply is high, and as such, the power is with the buyers. Sellers must compete with each other by lowering their prices to attract the buyer. On the contrary, if suddenly there is an increase in the number of people who want to buy a house, demand is high, and as such, sellers hold the power. Buyers must now compete with each other to be the highest bidder. This theory is exactly the same with stock prices. If demand for a stock increases, then the price will rise as buyers bid higher and higher to get their hands on the stock. Whilst if demand for a stock decreases, then the price will fall as sellers are forced to lower prices in order to attract a buyer. This theory of supply and demand applies to all of the thousands of businesses around the world, and this is why stock markets are such good indicators for confidence in the economy. If the market as a whole has a positive view on business and economic growth going forward, there will be more buyers than sellers. Stock prices will therefore rise as the buyers bid to own the stocks. Whilst if the market as a whole has a negative view on business and economic growth going forward, there will be more sellers than buyers. Stock prices will therefore fall as sellers lower their prices in order to find a buyer. Thanks everybody for watching, and please do subscribe to catch the next video.